Good afternoon, everyone. Thank you so much for joining me. My name is Nikki Young, and I'm a financial advisor with Northwest Financial Advisors, and we are a subsidiary of Northwest Federal Credit Union. I want to welcome you to this afternoon's presentation of 5 things all investors should know. A few compliance items before we begin. I want to be clear that this presentation is general in nature and may not address every single investing topic. We will have a brief Q&A at the end to provide you with an opportunity to ask questions. However, in consideration of all attendees, specific, unusual, or complex inquiries are better suited for a personal consultation. Please also be advised that this presentation is being recorded for the purpose of sharing the content after, but all attendee questions and comments will be removed to protect your privacy. Please also note our required securities disclosure. And with that, let's get started with the number 1 thing all investors should know. So the first thing all investors should know is that asset allocation drives 90% of our results. There are 3 major asset categories that most of us know. We have stocks, we have bonds, and we have cash. Asset allocation refers to the different weightings of stocks, bonds, and cash within our portfolio. And while it may be very exciting to choose between individual stocks, bonds, even mutual funds, it's really more important to focus on asset allocation rather than the specific investments. And the concept behind it is that in any given period, some investment styles are going to be winners and some will be losers. And that's going to vary over time. In a well-constructed portfolio, we want to see the addition of investment styles that behave and perform differently than the rest of your portfolio. And what that's going to do is it's going to accomplish 2 things. It's going to reduce overall volatility and produce a more stable return pattern, so that way we can reach our goals without having to go on an investing roller coaster to get there. How you determine your asset allocation should be based on your specific investment goals, the timeline that you have to achieve those goals, and selecting a portfolio that provides the best investment return for the amount of risk that you're willing to take. And I'm going to talk more about risk as we go along. Because if you have too much in bonds or cash, while it's considered to be more safe and stable than stock, it might not be enough to produce the returns that you need to meet your objectives or keep ahead of inflation. On the other hand, if you have too heavy a weighting in stock, yes, it can produce a higher return over time, but it can also be subject to larger swings in value in the short term. So your expected return and acceptable risk level must be viewed simultaneously. An investor must feel comfortable and informed on the downside risk associated with achieving higher returns. Academics have studied this issue for the past 2 to 3 decades and have determined that 90% of the variation or the difference in portfolio returns is due to asset allocation, not choosing specific investments. So the takeaway here is that focus on asset allocation versus specific investments. So I just talked about asset allocation, and that's represented by the pie chart on the left. It's how much stocks you have, how much bonds you have, how much cash. Diversification takes this process 1 step further by investing your money across different investments within the same asset class. So rather than trying to figure out what type of stock or bond is going to perform the best, you're going to invest in many types. And over time, the ups of one investment have the potential to balance out the downs of another, with the goal of reducing the risk level within your portfolio. And diversification can be summed up by the timeless saying, don't put all your eggs in one basket. If you look at the pie chart on the right, the blue stocks portion is broken down into subcategories. We have U.S. large cap, which represents the largest corporations in our economy. International, U.S. small cap, which represents the smaller corporations and businesses, and then emerging market, which represents countries that are in the process of becoming industrialized economies. So a diversification strategy here would involve spreading your money across all the different subcategories in hopes if one category loses money, then the other one will more than make up for those losses. Diversification mistakes and misconceptions. I thought this was really important to talk about because good diversification is investing in different areas of the market that don't behave the same. But there are approaches to diversification that may not fully capture the benefit of what a diversified portfolio is supposed to be. And here are the three most common that I often see. The first is similar investments. So if we look at portfolio one under similar investments, this investor holds 4 different funds: a dividend growth fund, a large cap value fund, large cap growth fund, and then the S&P 500. And they may think, hey, I've got 4 different funds, I'm diversified, but that's not necessarily the case. And one way you can really tell that is by looking at the names of the funds. 2 of the funds have the word large in it. 2 of the funds have the word growth in it. And if you looked at the stocks, the specific stocks in those funds, you'd probably find that they're all invested in the same exact thing, large U.S. companies. If you look at portfolio number 2, not being diverse enough. This investor holds a bond index fund, an S&P 500 fund. They're probably thinking, I've got bonds, I've got stocks, I'm diversified. Now, this example is better than the first portfolio, but the S&P 500 fund is exposure to the 500 largest companies in the U.S. But what about the other 2,500 or so publicly traded companies? There's also no exposure to international stocks or bonds. And then lastly, we have portfolio number 3, over diversification. This investor just owns probably a million funds. And while there isn't a clear tipping point as to how much diversification is too much, but at some point, the minuscule reduction in risk that you get from investing in yet another stock, it isn't worth it. You don't need to invest in 1,000 stocks in order to be properly diversified. And you probably shouldn't do that anyway. Most people don't have the time or the energy to research that many companies. And it can be really easy to lose track of what you already have when your money is that spread out. And I'm not sure if there is a, golden number for how much diversification is the perfect amount. But ideally, depending on your portfolio size, you want your money in at least 25 different companies max, but you really don't need to go overboard. The second thing all investors should know is that volatility is normal, necessary, routine, and good. Volatility is defined as how much variation there is in the price of a given stock or index of stocks or an investment. Simply put, it's how widely a price swings up or down, and it's really considered to be a measure of the level of risk in an investment. An investment or a stock, let's say, that has a price that swings, down, huge and then up huge, is probably considered pretty volatile. So volatility being normal. Investment prices can be influenced by many factors, including earnings reports, interest rates, elections, or pandemics. And each of these factors causes uncertainty with investors about the ability of our economy to survive. And markets don't like that uncertainty. But what history has shown us is that although it may take some time, we do survive, and then we typically see the investment market rebound and increase gains further. Volatility being necessary. It keeps excess in check and is a healthy resetting of stock valuations and investor expectations. If you think about the stock market as a pressure cooker, corrections, declines are the pressure release valve that allows enough steam to escape periodically to prevent everything from boiling over. It's only when market declines don't occur often enough that we should be a little wary. When we have stretches of high predictable returns with no volatility, it really gives investors a false sense of security. And that's the time where investors take on too much risk. And then when the market corrects and declines, they panic sell, locking in those losses. I could make a case that we are experiencing that right now. Right after the financial crisis, we had the longest bull market in history. Stocks rose for 11 years. So we had a lot of young, new investors taking on probably more risk than they should. Then we had a pandemic. Now we have inflation, and investor expectations are really being tested. Volatility is routine. Stock market corrections, which are a 10% or more decline, occur on average about once every 2 years. Bear markets, which is a 20% or more decline, occur on average about once every 3.5 years. So we have been here before. Each correction or bear market is really challenging to experience and go through, but it's not the first, it won't be the last. And in spite of all of that, the trajectory of the market over the long term is up. And then finally, volatility is good. Prices are on sale. This makes the perfect opportunity to buy quality investments for a fraction of the price and potentially achieve higher returns. Almost everybody, including myself, loves a good sale, but everybody shies away from it when stocks are on the decline. And I'm not saying that just put all your money into the market during every correction or fair market. It's something that needs to be done prudently, but it can add to your gains by having a plan in place that includes ways to invest a little more when the market is down. When you have a sound, well-constructed, long-term portfolio, doing nothing in times of volatility can be the most impactful action that you can take. When in doubt, I love this quote from successful investor Warren Buffett. He says, if you aren't willing to own a stock for 10 years, then don't even think of owning it for 10 minutes. And so the takeaway here is that just staying the course during times of volatility is critical to success in investing. The cost of panic. I think this is really interesting. So we all remember the 2008 financial crisis. During the time of its peak in 2007 to its bottom in 2009, the S&P experienced more than a 50% drop in value. So a lot of people panicked. Not surprisingly, this represented a lifetime worth of their savings, and it was decimated. So deciding to cut their losses, they sold stocks and moved into the safety of low-yield investments like T-bills, CDs, or just cash in their bank account. But then what happened was, over the next decade, the market delivered a cumulative return that exceeded 400%. And I just want to say that past performance is not indicative of future performance. But this is a big picture example of how panic selling at the wrong time can give you all of the pain with little to none of the benefit of investing in the first place. On the other hand, those investors that were able to weather the volatility storm and stuck with their long-term plan ended up being rewarded for their patience. If you've been keeping an eye on your portfolio this year, there's a good chance that you're stressed out, but turning that anxiety into action could be really harmful in the long run. And then, if you do decide to sell your investment, you have to make another decision, right? You have to decide, when should I get back into the market? And the thing that gets people is, once you're out, it's hard to convince yourself to get back in, especially in the near term. Investors typically wait until the market is back at its high to get back in and start investing again. And in addition to that, selling out of the market after the worst days is likely to result in missing the best days that follow. And if you look at this graphic here, it supports that. So from 2002 to 2021, the 20-year period, 7 of the best 10 days occurred within 2 weeks of the 10 worst days. 6 of the 7 best days occurred immediately after the worst days. The second worst day of 2020, after the pandemic was declared, March 12th, was immediately followed by the second best day of the year. And there is a cost to missing the best days in terms of your portfolio balance and your return. If you look at the performance of a $10,000 investment between that time period, by staying fully invested, you have a little bit over $61,000 and 9.5% return. And then the more days that you miss, you see your account value and your returns dwindle down into nothing or even negative. And that's how people create a narrative that investing doesn't work or that it's not worth it. And it's just not accurate. So the temporary declines are the price that investors pay to be able to get a permanent advance. So if you decide to invest in the stock market, volatility comes as a part of the package. So here are some best practices for overcoming volatility fear. Remember the past. When the stock market dives, remember this isn't the first time it's happened. Our economy has been so resilient. If you think about all the things that we face between the stock market crash of 1987, the dot-com bubble, the Great Recession, the pandemic, and now a lot of young investors who've only witnessed the bull market, as I said, are more prone to become emotionally charged during times of prolonged volatility because we've never experienced this before. So just keeping the fact that, we really do have a resilient economic country here will help kind of overcome and put things in perspective when it comes to that. Consulting with a financial professional. Consulting with a financial expert will only help you evaluate the accuracy of your thinking, and it also gives you something else that you need, which is time to think. Having a financial professional to speak with will give you an opportunity to reevaluate your approach to investing and assess your risk level. Maybe your portfolio is not as diversified as you think or as it should be. Understanding the role of the media. In case you didn't know, the media outlets do not have your financial interest in mind. Their goal is to keep you in fear and tuned in for better ratings. But I watch the financial news and keep up with that, not only because it's part of my job, but I think it's important just in general. But personally, I think that some of the financial daily news reporting is about as useful as checking yesterday's weather report to decide if you're going to need a number. So just keep that in mind as you get the influx of financial data and financial news coming from the media. And then be clear on your risk tolerance. And I'm going to speak more on that in a minute. But many investors make the mistake of thinking that they have more tolerance for risk than they actually do. And it takes a sharp decline in stocks to get people to have a realistic sense of what they'll actually do during a sustained downturn. The third thing all investors should know is to focus on the long term for consistent results. I would say that the beauty in investing is that long term, the equity market strength is inevitable. Short to intermediate term is unknowable. So it only stands to reason that we invest our capital and our energy in focusing on the long term. And the more that we do that, the more we can relax and the more optimistic we're forced to become. So when should you take a long-term perspective? If retirement for you is more than 20 years away, if you're more than 2 decades out from retirement, you have a considerable amount of time before you stop working. And since long-term investments like stocks need time to potentially grow, they're a decent asset class to build wealth for that time. Also, when you're younger, you have more time to save and recover from stock market downturns. If you need a plan for a goal that's 5 to 10 years in the future, and lastly, if you want long-term protection from inflation. The chart here supports that by showing over a 20-year period, the longer you have, the more chance you have of having positive returns. Over 20 years, stocks were up 100% of the time. Even the 1-year data, 73% is not bad, but the takeaway is that it is time in the market, not timing the market, which is key to returns. The benefits of long-term investing. Better long-term returns. When your investment returns produce earnings, those earnings can get reinvested and you can earn even more. Albert Einstein described it as the eighth wonder of the world, which is earning returns on your returns. Now, keep in mind that just by reinvesting your returns, it's not there's gonna be periods where your money doesn't grow, but it can have a significant impact because the value of compound investment can turn out to be far greater than just your contributions alone. If you look at the effective compounding chart that we have here, you see that the 7% returns have been invested each year. The gains were added to the initial contribution, and the investor was able to grow their investment even further. And it doesn't mean that every single day of these years the market was positive, but by staying invested, the investor was able to capture the full upside of that time period. It smooths out the highs and lows. It allows you to remain focused on your goals. Goal setting is so important. It's such an important part of long-term investing because it helps you to set emotions aside and focus on a predetermined set of financial objectives. When constructing your investment portfolio, be sure to identify a realistic timeline for each goal and then structure your portfolio in accordance with that time frame. And then it helps you beat inflation. Inflation presents a big risk to invested capital. We are currently experiencing higher than normal inflation. I'm sure you've seen the prices at the grocery store. It's astronomical. But if you have excess cash in your bank account, it's really something to consider. Because let's say, for example, when you had $100,000 in cash last year, a year ago today, inflation is running at 8%. So you have lost $8,000 of purchasing power of your money in a year. So now your $100,000 will only purchase $92,000 worth of goods. And then lastly, favorable tax treatment. Selling investments that were held for more than 1 year receive long-term capital gains tax rates. Simply put, long-term capital gains taxes are much lower than your ordinary income taxes, as long as you hold that investment for more than 1 year. And if you hold it for less than 1 year, you'll just end up paying the ordinary income taxes, which could be higher. And then I wanted to share a story about the man who turned $1,000 into $2 million. And I remember reading about this story when it first came out. So his name is Russell Bromell, and he lived an extremely simple life. His family had lost everything during the Great Depression, so he grew up poor and just really valued every penny that he was able to acquire. And so 70 years before his death, he purchased $1,000 of Walgreens shares. And he felt strongly that in the fact that Americans would always need medication, so he chose to invest in this pharmacy chain. He refrained from selling during all of the, economic incidents that we had, the dot-com bubble, the 9/11, Great Recession, all of that. He paid more attention to the business and less to the stock price. All he did was keep an eye on the business and saw it growing exponentially. And as the company's earnings compounded, so did his tiny contribution. So he passed away in 2018, before his 100th birthday, with a net worth of over $2 million. And he ended up donating it all the year before his death. And the reason why it was such a story is because everybody in the town that he lived in, which he never moved from when he was a child, nobody knew that he was well off. They knew of him in the community, but because he lived so frugally, they didn't know that he had that much money. And really, that that's it. He never inherited $1 million. He never won a casino bet, but he was able to build a sizable fortune that he gave all away. And it's just a classic example of successful long-term investing with, there's no secret sauce to it. The fourth thing all investors should know is understanding the difference between investing and speculating. So an investment is an asset or an item acquired with the goal of either generating income or growth in the future. Speculation tends to be financial transactions that have the substantial risk of losing all value, but with the expectation of significant gain. Now, every investment carries some level of risk. However, the potential of losing the entire investment or close to the entire investment is largely what differentiates investing from speculating. Other factors to consider if you're going to decide whether or not to engage in speculation transactions is your tolerance for risk, the decision criteria for you selecting the investment, and then your attitude towards risk as well. And the examples that they have here of highly speculative investments include options, foreign currency, cryptocurrency. I know cryptocurrencies are extremely popular right now, and I'm not saying that any of these investment types are bad or good. I really don't believe that any investment type is bad or good. It's either appropriate for you or it's not. And that should be based on your risk tolerance and your goals. It's always up to the individual on whether or not to speculate. You have to decide that for yourself. So the takeaway here is to thoroughly examine your own risk tolerance. And I want to go a little bit deeper into risk tolerance because everybody says, oh, know your risk tolerance, but how do you really define that for yourself? And one way to do that is with risk scoring. So if you've invested before, you may have taken some type of questionnaire that asks you questions about your goals and your timeline to achieve those goals and what return you want to get. And what risk scoring does is similar, and it takes the answers to those questions and generates a score that correlates to an investment objective. So the 5 investment objectives that we have are income with capital preservation. That's going to be your least risky. It goes up from there. So you have income with moderate growth, growth with income, growth, and then finally aggressive growth. So for example, with this investor, based on the way that they answered these questions, they generated a risk score of 59, which correlates with growth with income. So she would need to be willing to accept a 14% loss at any point in time in order to have the opportunity to achieve a 26% gain. Now, the risk score, although it says, risk of 14% loss based on the way that you answer the question, it is not the final say. If a 14% drop would have this individual staying awake at night with worry, then they need to consider reducing the risk in their portfolio even further. So even if financial theory says you should have this much stocks or high risk investments in your portfolio, you need to be able to sleep at night. So just for perspective, the market this year is down about 14%. So just consider what you've done with your portfolio or what you would do. By not investing for your risk tolerance, it's almost impossible to avoid panic selling at the worst possible time. And the fifth thing all investors should know is that you could go at it alone, but you probably do better with a good advisor. And it definitely sounds self-serving, but really a good advisor shows you how to reach your goals, make your investments more efficient, and reduce your taxes. And for the details of this, I'm going to use Vanguard, which is a company that is extremely popular with do-it-yourself investors. They put out a publication called Bringing Value Through Advice. in which they describe how financial advisors bring value to their clients. So the first is with behavioral coaching. Investing invokes emotion, but your advisor can help you maintain a long-term perspective and a disciplined approach based on your financial plan. This practice alone is how your advisor can more than earn his or her cost. I really like to use the analogy that the most premier athletes in the world have coaches. At this time, Tom Brady probably doesn't need a coach to tell him how to be a quarterback and throw the ball, but he does need a coach to put the pieces around him in a way that gives them the best probability to win. So no matter how good an investor is, they could probably benefit from a coach or an advisor. And we're actually seeing an uptick of investors that have some element of the do-it-yourself approach, but then also leverage the services of an advisor as for guidance. And then portfolio construction. Portfolio construction needs to be in a cost-effective, tax-efficient, and total return-oriented manner. I'll use an example. A lot of us probably at one time or another may have had a 401k from a previous employer. I had a client in that situation, and I was looking at these two accounts. One was doing really well, and the other was kind of stagnant, not moving, had little growth at all. And it's not that one account was better than the other, but the account with a lot of growth was in a growth fund, and the account that was not moving at all was in a stability fund that had more of a focus on protecting his principal. And it's not that one account was better than the other. They just had two vastly different investment styles inside of the account. Had he been working with an advisor before, we would have caught it, made some changes, and not let his retirement funds do very little for 10 plus years in a fund that didn't match his risk tolerance or his timeline. He would have benefited from having an advisor doing portfolio construction. And then wealth management. Given the importance of selecting a suitable asset allocation, it's also vital to maintain that allocation. What happens when you want it to be 50% stocks in your portfolio, excuse me, and then stocks do so well that you end up being 70%? A lot of times when that happens, it feels good, so we're like, just let it ride. But an advisor, a good advisor might say, let's rebalance this portfolio. Let's get you back down to 50% and use the gains to take advantage of other buying opportunities, which is the essence of the buy low, sell high strategy that we all say that we want. So the takeaway here is to consider whether you do better with an advisor or risk going at it alone. If you are interested in receiving a PDF copy of a Vanguard study, just please let us know. We'd be happy to send that over to you. In closing, I'm going to share the Northwest Circle of Financial Light, which was created by one of our founders many years ago. Tonight we went over an asset and investment management, and some firms hang their hat on investments. That's all they want to discuss. We feel that to be doing a good job for our clients, we need to touch on more than that, all of these items. And a few examples with cash flow. So cash flow, it really is the heartbeat of any successful financial plan. It is what you have coming in versus what you have going out. And it's especially important to understand our cash flow in retirement, because where's your income going to come from? And is it enough to cover your expenses? Because if not, then we may have some decisions to make, like when is the right time to pay Social Security? Can your retirement plan survive a cut to Social Security? Who knows, if that's going to happen. So cash flow, very important. Risk management, evaluating whether or not it makes sense to carry life insurance into retirement. Long-term care is another huge issue that many people are not prepared for and can really have a significant impact on your assets that you thought that you were going to end up leaving to your heirs and your loved ones, but it ended up paying for, medical expenses. Tax efficiency. It's our view that tax rates are going to be higher in the future. So does it make sense for you to consider paying a little tax now in order to avoid a lot of tax later? There's a specific account that allows for growth tax-free in retirement called a Roth IRA. So if you're eligible to fund one, then there's not really a lot of situations where it doesn't make sense to do that. Distributions, which is what accounts do you take money from first? What will be used for your month-to-month expenses versus what will be used for one-off big ticket items? And then lastly, your estate plan, which is making sure that your money goes where you want in a quick, efficient manner when you're no longer here, and how your thoughts may change on that over time. So in our view, these are the items that should be discussed regularly with your chosen advisor as a part of your financial plan. We at Northwest Financial Advisors would be happy to help you with your investment decisions as a part of your overall plan. At the conclusion of this presentation, you will receive a survey. Your feedback on the presentation is greatly appreciated, but you'll also have an opportunity to meet with me or one of our other advisors for a complimentary consultation. You'll just fill in your contact information and we'll follow up with you to get that meeting scheduled. We have advisors that take appointments at our many branch locations, and you'll be able to specify which location is most convenient for you, as well as virtually. Please note our required security disclosure that just indicates that, every individual situations are different. There's no guarantee of investing in it all.